Hello there. If you're hopping on this video, you are obviously building a business in a province where PST applies to you. So, looking at PST as it applies to a barter deal, the easiest way to understand it is through an example. We're not going to include the GST component here, because it is covered in a different video if you want to see how that basically nets out to nothing. So let's begin. For simplicity, we're just going to use a 5% PST. I know that's not the case for all provinces, and some provinces don't even have PST. But hey, you're here because PST does apply to you. Okay, so in our example, this is you, the savvy, very cool business owner. So now, let's say another very cool and savvy BarterPay member loves your products or services and buys from you. The total comes to $1,000 plus the PST, which is $50. The way you complete the transaction is very simple. You take the entire amount on barter, including the $50, so the bill will come to $1,050 in barter credits. Now you, the seller, will pay $50 in Canadian dollars to the government. That $50 payment obviously would happen on either a monthly, quarterly, or annual basis depending on what your filing term is. Now stay with me here because it's going to make sense as we keep walking through the entire process of buying and selling. So far, a client sent you $1,050 in barter credits and you sent $50 Canadian to the government. Next, let's say you wanted to set up a party for your clients and you get a caterer on barter to do it. To keep this simple, we're going to say the job came to $1,000 plus PST, so the total is $1,050. Now it's your turn to pay the caterer $1,050 in barter credits. Your barter account will reduce down to zero and you didn't have to pay anything in Canadian dollars. The caterer, who sold to you, now sends $50 Canadian to the government on your behalf. It's all about the seller remitting the taxes instead of the buyer. So, it's a wash. It really is as simple as realizing all comes out in the wash and at some point, the PST gets paid. Obviously, not every transaction is the exact amount of money in and out like I'm using in this example. Whether it's one transaction or a series of them, it works out all the same. Let's take this a step further. Why did we set up the system this way? Why pay PST in barter when you buy? I happen to be an accountant with many years in the barter payment space, and I have to deal with managing people who process transactions. So I just happen to know the most logical way to complete a barter deal. If clients start paying taxes in cash when they buy products or services, they've actually doubled the amount of transactions that need to be processed, as well as forms of payment that need to be managed. So, you're doubling the bookkeeping work simply by insisting your barter customers pay you the taxes in cash. It's much smoother and much easier, much cleaner, from a bookkeeping perspective, to actually work with it all in barter. And then, at the point in time where cash needs to be remitted to the government, it's a simple one-payment process. The transaction for paying the province would just be the same one transaction that you would have to do anyway. So, reducing your bookkeeping entries is obviously the ideal way to go. You're a business owner. You need simplicity, right? Another hiccup that happens when you insist the buyer hands over cash to cover the taxes is that you're now not in control of the cash. The buyer is in control. In the example, on the cash side, there is this assumption that you are collecting the $50 from the other party in the transaction. If you're used to having receivables, you might be sitting on a receivable now with this person for the $50 they owe you. And so you are out both the $50 when you bought your catering job, as well as the $50 that you had to pay to your province when you sold your products and services. And so now you're in fact out $100, or double the number. Whereas when the buyer pays you 50 barter credits instead of cash, the only time that cash is leaving your pocket is when you're in control of it, which is when you're remitting it to the government. And, again, when you buy your catering job on barter, you won't be coughing up the $50 for the PST then. So, we're almost done here, but just to sum it up clearly, your cash outlay happens at the time of the sale, but it is deferred based on your remittance period. And so, if you're a monthly filer, essentially, it's at the time of sale. If you're a quarterly filer, it might be a few months later. Or if you're an annual filer, it's the end of the year. Overall, though, because your barter sale shouldn't be more than, at the most, 20% of your overall volume, to remit the PST possibly in advance of you purchasing something, like your catering job, it shouldn't be something that has a major impact on your business. In terms of your overall business, it would be fairly insignificant. As we wrap this up, I want to mention that if you have any questions about this topic, please contact your Barter coach or our accounting team. We are here to help in any way we can. Have a great day.